Hello everyone. So in my today's video, I'm going to talk to you about a company called Sambhv Steels and Tube Limited, formerly which was known as Sambhv Sponge Power. It's a rapidly growing, fully backward integrated steel manufacturing company based out of Raipur, Chhattisgarh. So let's see how do they work, right? So as I said, they are fully backward integrated company. So they produce sponge, and from that sponge they make the the required raw material, and then they make it into pipes. So let's look at the various products that they sell, right? So they have pipes and tubes, stainless steel, structural steel. And in these, right, if you look at the pipes and tubes, so they manufacture ERW, black pipes, galvanized pipes. So these are normally used in water supply, irrigation, in solar panel mounting structures, scaffolding in greenhouses. And in the stainless steel, they have stainless steel CR coil and stainless steel HRAP coils, right? So these coils are mostly used in kitchenware, automotive parts, railway component, and industrial storage tanks. And the structural steel, which are those hollow structures, which are either in square or in rectangular form, and door frames, they are mostly used in infrastructure, model, building frames, and furniture. So these are the main products that they have, right? And if we see, even though they make the raw materials, majority of their revenue comes from their finished products. So let's look into their recent numbers, right? So the revenue was up by 60% to 589 crores from 369 crores last year. PAT was up by 113% to 24 crores from 11.3 crores. And earning per shares was up by almost 74% to 0.82 rupees from 0.47 rupees. So the management confirmed that the recorded high sales volume, and especially in the value added product, where they were able to sell almost 2.6 lakh tons of product, making a growth of almost 60% if we compare it to the last year. But the only downside was that their EBITDA margin was impacted, right, which fell down from almost 10.39% last year to 8.68%. So the management said that this was affected by temporary maintenance shutdowns and the raw material price volatility. And they are confident that it will be back to normal. And in Q4, they will have much better numbers. So if you look at the actual numbers, their EBITDA per ton, what management is targeting is to be around 7,000 to 7,500 for the whole year. But in Q2, the EBITDA level was around 6,100, which fell down to 5,200 in Q3, and that's why the people were worried and they had asked question on the management. But management is confirmed that the prices are back to normal and the plan is running on full capacity, and they are confident that they will be able to achieve the target of around 7,000 to 7,500 EBITDA per ton in Q4. So let's look at their growth plan, right? So this company is going very big on their growth plan because they see the demand and they want to cater to the demand because India is growing and the demand is there everywhere, right? So in Q3, their galvanized pipe capacity has increased to 116,000 from 1 lakh tons per annum, and they are doubling their stainless steel CR capacity from 58,000 tons per annum to 116,000 per annum. And this increase in production capacity will be implemented by March 2026. So, which is a very good sign for the company. So, they are doing a greenfield expansion also, where they will make around 3.5 lakh tons of stainless steel in phase one, and they are planning to commission this by Q4 FY27, which will be most probably March 2027. So as they are growing and they want to, expand the plant, and steel manufacturing is not, it's not that cheap. So they require a lot of capex, right? So the management is saying for this phase one of this greenfield expansion, they require around 930 to 940 crore rupees. And they are saying that out of this, 250 crores is already spent in December this year, and the remaining 700 crores will be spent in the full of FY27. And management has said that they're going to cover this capex through internal as well as external means. So they are going to raise around 600 and 100 to 650 crores from long-term debt, and the balance will be, will be used from the internal accrual, whatever profits they make. So that is a good sign. And then they have the current plan which they have in Sarora. Currently, 55% of the electricity comes from their own power plant, but and 45% comes from the power supplied by the government agencies, right? So what the management is trying to say that they are planning to move this 45% also to their own, their own power plant, which they are going to make. So they are saying that once they are able to make their own power plant and use their own electricity, they will be able to save around 50 crores per year on electricity cost. And the capex to build this plant would be around 125 to 150 crores. So in short term, yes, the cost might be quite high, but when we see from the longer term perspective, saving annually 50 crores on electricity would it's quite huge, right? And the other thing that they're doing for their growth is co-branding strategy. So what does that mean? So what they're doing is they are partnering with external manufacturers to produce their own branded pipes. So they can triple their branded sales volume. So that's what their focus is, because this is where the margin is and this is where the main profit lies. So if we see from the growth perspective, they are doing everything possible to grow. They are expanding their capacity. They are in the plan to set up a new plan which is divided into phase 1, phase 2 and phase 3, out of which phase 1 will be completed by end of FY27. So that's all sounds good, but what are the risks involved, right? Because anyone who's doing business, risk involved, and especially in the steel business. So first of all, we need to understand that steel is a commodity cyclical business. So the fortune of the company will depend upon the steel prices. If the steel prices go up, it is good for them. But if the steel prices come down, it would be quite bad for them. The reason is why, because they have to lower their prices, which will reduce the bottom line. And we need to understand that running a steel manufacturing plant is a very high capex. So the fixed cost is quite high. They do not have that much variable cost, but fixed cost is quite high. So if the bottom line, it will impact quite badly. And they are a working capital heavy operations, right? So to just to run their day-to-day business, they require a lot of capital. And if anything goes wrong in the working capital, that could also impact their sales and the bottom line. So if personally, what I see from overall, management is trying to do all the right things to grow, and they are putting everything in place. But at the same time, there are challenges which we need to be careful of it. So all we have to do is continue tracking the business every quarter and see how things are progressing. Are the steel prices going up or they're coming down? So whatever the timeline that the management is given for the expansion capacity and the new phase 1, is it on track or are there any delays? This all need to be taken into consideration, because that will decide how the market reacts to this company, right? So if you like this video, please do subscribe to my channel. Thank you and God bless you.